I love the TFSA. Love it. And that's probably because I don't really like paying taxes. What I don't like is the name. It's a terrible name, and we'll touch on that in a little bit. But the main point of this video is to show you the ropes of the TFSA, what to focus on, and how to use it like a boss. So let's do it. The first thing that you need to know is that normally in Canada, when your money or your investments grow and make you more money, the growth that you make is actually taxable, unless it's in a special kind of account like a TFSA or an RSP, etc. For instance, if you have a savings account with 10 grand in it and it earns $400 in interest throughout the year, well, you have to actually pay tax on that $400 that you earn. They're going to send you a little slip at the end of the year that you got to report on your taxes. And it's just going to get stacked on top of all of the other income that you made throughout the year, and it will be taxed at whatever your top tax bracket is. Let's just say, for argument's sake, that your top tax bracket is 40%. So 40% of that $400 that you just earned disappears to taxes. $160, bye-bye. And that leaves you with a paltry $240. Now, there are other ways that your money or your investments can grow, like through capital gains and dividends, and those are taxed a whole lot more gently than interest is, but for brevity's sake, we're just going to leave that alone for now. The focus here is the tax-free savings account, and it is delicious precisely because it eliminates all the tax on that growth, no matter what kind. You don't pay any tax ever on any of the money that you earn in a TFSA. Now, there is a slight exception to that with foreign dividends paid, but we don't need to worry about that for today. The basic gist is all the growth you make, totally tax-free. Awesome. Love it. So the first thing you want to do is make sure that you're putting whatever you can into your TFSA. Do not leave your money in a regular taxable account, also known as a non-registered account, when you have the option in the room to have it in a non-taxable account. I know that sounds ridiculously obvious, but people do it all the time. I see it constantly. People pay tax when they don't have to. And always keep in mind that Canada Revenue Agency, CRA, they're never going to chase you down to remind you to do this. This is something that you have to do on your own initiative. Now, where we run into a ton of confusion on the tax-free savings account is that due to its awful name, many people assume that it's just a savings account because it's right there in the name, tax-free savings account. But it is not. Much like an RSP, it's just a shell or an account that you can stuff all sorts of different kinds of things into, all sorts of different investments like mutual funds, GICs, ETFs, stock, bonds, and yes, even a savings account if that's what floats your boat. Basically, a TFSA is super flexible. You can do a lot with it. There's a lot of things you can put in it, but not a rental property. Nope, not allowed. Which brings us to the second major point. What should I stuff in my TFSA? The answer to this question totally depends on your situation. More specifically, it depends on when you think you're going to need the money that you're wanting to put into your TFSA. Let me break this down into 3 common scenarios that I see all the time. 1, the money that you have available to put into your TFSA is meant for things like emergencies or maybe the down payment on a home or a vacation or whatever, some kind of need that is short-term in nature. In this case, you probably want to be a lot more cautious or conservative with the money, and you don't want to expose it to a lot of volatility. Now, you can be more aggressive and that might work out for you, but it can also go the other way too. And if the money that you needed for, say, a down payment drops by 20% when you need it, well, that could put you in a pretty bad position. So if your goal is short-term in nature, then you're likely going to want to stick to something a lot more conservative, like a high-interest savings account or maybe a GIC. Scenario 2. You have a lot of resources and you just want to milk the TFSA for all it's worth. And this is actually where the TFSA really shines. In this case, you want to hold as many of your long-term investments as you can inside of your TFSA, things like mutual funds or stocks or ETFs, types of investments that have the potential to grow at a much higher rate than a GIC or a savings account can over the long run. And since all of the growth is tax-free, you might as well try to get as much growth as you can, or at least as much as you're comfortable with. Because obviously, the more money that you don't have to pay tax on, the better. And lastly, scenario 3. This is where you have some of your money that you want for short term and some of the other money that you have available you actually intend for long term, like maybe retirement or something like that. So in this case, you can actually do both. I'd recommend setting up a separate account for each one of them so that it's really easy for you to track what the two different goals are. And fun fact, you can actually open as many TFSAs as you want at as many institutions as you want, as long as you don't go over your total limit, which we'll touch on in a sec. But here's a little pro tip. Sometimes for clients that have a spouse, what we recommend they do is they open the short-term TFSA in one spouse's name and the long-term TFSA in the other spouse's name. And the reason that you might want to do this is that it's really easy to compartmentalize. You can keep things separate and you know that the one is in this person's name and the other is in this person's name. And this way you can take advantage of both of your TFSA limits as well. Makes it really easy to track, keeps it super clean. And this brings us to TFSA limits because unfortunately you can't just put as much money as you want in here. There is a ceiling and it goes like this. Starting in 2009 when the TFSA made its debut, everyone who was 18 and over was given the first $5,000 of room. And with every new year, we get more room. And from time to time, they increase the amount of new room we get to keep up with inflation. So you can see we got the first $500 increase in 2013, and that held until 2015 when the conservative government bumped the limit to $10,000 for the year. But then Trudeau took over, dropped it back down to $5,500, and we've been trucking along with a $500 increase every 3 or so years ever since. Now, if you haven't used all your room or even any of it, no worries, because every year that you don't use it, it just rolls over into the next year and it keeps piling up, patiently waiting. And whenever you're ready to rock and roll, you've got all of that room available to you. So if you were 18 in 2009 and you've never used any of your room, you have all of that combined room now available to you. And that's $88,000 in 2023. And if you have a spouse that hasn't used their room either, well, that's a combined $176,000 worth of room. Or maybe you've used a bit. Maybe you put $20,000 a few years back and you haven't really done anything with your TFSA since. Well, now you have $68,000 of room because you've gobbled up 20 of it, but haven't used any of the rest. And who knows, maybe you're never going to end up needing all of that room, but I wouldn't count it out either. I have seen a lot of room get gobbled up very quickly by things like an inheritance or an insurance claim or downsizing a house and having money left over from that. Either way, paying attention to your tax-free savings account room is extremely important if you're anywhere even near the limit, because the penalty for over-contributing is nasty. 1% per month of the overage. So if you accidentally put $10,000 above your limit and left it in there for a year, well, that's $100 a month or $1,200 penalty that you would have over the course of that whole year. No good. So you do want to know your room. And the easiest way to find out your room is actually just to contact CRA. And as you can see here, you can just give them a call or even quicker, log into your CRA account if you've got that set up. If you haven't got that set up yet, that's a bit of a gong show getting it done, but it's something you pretty much need to do at some point, so I'd recommend just ripping off the Band-Aid on that one. However, you do need to know that financial institutions don't report all the numbers on your withdrawals and your contributions until the year is over, and then they just send all that information to CRA once. And so CRA doesn't actually have updated numbers for you that they post until the end of February, so keep that in mind. The last fundamental thing that you need to know about TFSAs is that there are no tax deductions for any of the money that you put into the TFSA. Zero. It is not an RRSP. Actually, it's kind of the opposite of an RRSP. With an RRSP, you get a tax deduction for any of the money that you put into the account, but then you have to pay tax on it when you pull it out. With the TFSA, you get zero tax deductions for whatever you put in, but then there is no tax on anything you pull out. So they're both great, but for different reasons and at different times. And like I always say, you got to know your own situation, or you got to pay someone else to know it for you so that you can figure out what makes sense for you at any given time, and that is a moving target. Things change. Now, of course, there are a bunch of details today that I didn't get into because I wanted to keep this simple and I wanted to make sure that you understand the fundamentals of how to use this bad boy without drowning in all the minutia. But the last thing that I will slip in here is that you do not need to worry about the implications of withdrawing money from a TFSA, because there are none, ever. Not only are withdrawals not taxable, but they also won't affect things like old age security. No clawbacks. It's kind of like magic, except you can spend it.